Hello and welcome. My name is Robert, and this is my Bloomberg project, a requirement for investment analysis at Southeastern Louisiana University. Let us begin with an overview. Today we will discuss and analyze information from 10 companies across two industries, educational support services and energy. As we stroll through the various components, we will use process of elimination to narrow down our focus to a single company in each industry. Once the top company from each industry has been selected, we will compare the two. Finally, we will take a look at what you can expect in 3 years should you invest $1,000 today. As for our goals, while the goal of managers is to maximize shareholder wealth, my goal will be to help you understand my investment recommendation based on data pulled from a Bloomberg terminal over the last 5 years. The first set of companies we will discuss represent education. As you can see with the top row going from left to right, the 5 education companies we will be looking at today are New Oriental Education and Technology Group Incorporated, Chegg Incorporated, Houghton Mifflin Harcourt Company, Pearson plc, and Scholastic Corporation. I'll be covering financial ratios, analyst recommendations, and stock performance to present to you which one of the 5 companies I support and why. Let's take a look at ratios. The 3 categories of ratios I will cover are profitability, as well as an ROE decomposition, leverage, and liquidity. Let's take a look at 3 profitability ratios. As you can see here on the top left, we have the return on equity. Return on equity shows us the amount of net income returned as a percentage of shareholders' equity, or how much profit a company generates through shareholders' investment. As you can see here, New Oriental has maintained the steadiest return over the 5 years. Chegg, Houghton Mifflin, and Pearson have been performing in the negatives. On the top right, you'll see return on assets. Return on assets indicates the efficiency of management using assets to generate earnings. As you can see, New Oriental is the steadiest of these 5 companies, while Chegg, Houghton Mifflin, and Pearson all have negative performance. On the bottom left, we will see profit margin. Only New Oriental and Scholastic have shown steady progress over the last 5 years. Chegg spiked, then plummeted, back into the negatives, and has been steady ever since, and Pearson has fallen significantly over the last year. After reviewing this data, I believe it is safe to eliminate Pearson plc from being an investment recommendation, as they have plummeted significantly on all fronts over the last few years. Let's break down return on equity a little further and take a look at the ROE decomposition. Here we will be discussing the tax burden, interest burden, EBIT margin, and asset turnover. Starting with the tax burden, the higher the number, the less paid in taxes. Some may say that this is a good thing, but it can also represent declining sales. After all, the lower the sales, the lower the taxes. According to this graph, New Oriental and Houghton Mifflin have been paying the most in taxes over the course of the 4 years. Scholastic is showing a significant spike in 2015 with a tax burden of $985. Looking at the interest burden, all of the companies showed generally steady performance over the 4 years. This number shows the interest requirements from debt taken on by the company. An interest burden of 1 usually means the company has no debt. Moving on to EBIT margin. Lower EBIT margins represent lower profitability from the company. In this case, our 2 lowest performers are Chegg and Houghton Mifflin, not even producing a profit, while New Oriental and Scholastic have proven to be profitable. Lastly, looking at the asset turnover, this number generally tells us how well a company is generating revenues from its assets. Chegg and Scholastic are the top performers, while Houghton Mifflin and New Oriental are median performers. Let's take a look at how debt is affecting each company by taking a look at a few leverage ratios. We will be exploring 3 of the key leverage ratios, starting with the equity multiplier, which is a variation of the debt ratio. It shows us how companies are financing their operations with debt. The higher the equity multiplier, the larger portion of asset financing is attributed to debt. The only company that has been consistent with their equity multiplier is New Oriental. As you can see here, Chegg brought theirs down and leveled it out. Houghton Mifflin brought theirs down greatly, but it is slowly climbing back up, ending off 2016 at 2.82, the highest of the 4 remaining companies. Scholastic was able to dip, but has been coming back up and been steady year over year. from 2015 to 2016. The long-term debt ratio represents how much of a company's debt's financing assets are lasting more than 1 year. As you can see, New Oriental and Chegg are both at 0, while Houghton Mifflin has skyrocketed from 5.8 to 28 in the last few years alone. Scholastic's long-term debt obligations have been reduced and are nearly at 0. The final leverage ratio we will be looking at is the times interest earned ratio, which indicates how many times a company can cover its interest charges on a pre-tax earnings basis. Of the 3 companies shown, only Scholastic is able to cover its interest charges, while Houghton Mifflin and Chegg both appear in the negatives. At this point, it would be safe to say that we can eliminate Chegg and Houghton Mifflin as viable investment interests, leaving New Oriental and Scholastic. Let's take a look at the liquidity ratios for both companies. Here we have the current, quick, and cash ratios. These ratios represent a company's ability to pay debt obligations. The current ratio shows for every $1 in short and long-term debt obligations the company has, how much cash they can get from selling their assets. New Oriental has been hovering around the 2.0 range, meaning that for every dollar they owe, they can convert their assets into $2 cash. As of 2016, Scholastic has greater flexibility with their assets by about 50 cents on the dollar compared to New Oriental. When looking at the quick ratio, we are seeing a more conservative approach, taking inventory out of the equation and seeing how much the company can afford its liabilities using cash and other assets. When looking at this chart, we see that Scholastic is holding more value in its inventory than New Oriental. New Oriental is able to pay off their debts slightly better than Scholastic. Lastly, the cash ratio restricts the liquidity ratios the most, almost like an indicator of a firm's value under the worst-case scenario where the company is about to go out of business. This ratio tells creditors and analysts the value of current assets that could be quickly turned into cash and what percentage of the company's current liabilities these cash assets could cover. According to this graph, New Oriental outperforms Scholastic by about 75 cents to the dollar. Scholastic breaks even for their cash to current liabilities. Now let's go back to the education page and take a look at the recommendations from analysts. Here we will review analyst recommendations on our 2 remaining education companies. Starting with New Oriental, represented here by its ticker EDU, based on 23 analyst recommendations with 4.8 out of a 5 consensus rating, 90.5% are recommending buying, while 9.5% recommend holding the stock. Moving on to Scholastic, represented by its ticker SCHL, based on 2 analysts with a consensus recommendation of 4.0 out of 5, 1 recommends buying, the other holding. As both of these companies have seemed to be performing relatively well, the final item that we can review prior to making my recommendation to you is each company's stock performance. As of today, July 14th, 2017, New Oriental is trading at $79.78 per share. The calculated value of the company's stock, factoring in potential dividends and stock value with a growth of 20% year over year, we see the stock is valued at $168.05. New Oriental is an undervalued stock. On the other hand, Scholastic is currently trading at $42.88 with a calculated value of $32.35. Scholastic is overvalued, meaning you can spend $42 for 1 share of stock that is valued at $32. Lastly, let's take a look at expected earnings and dividends per share for both companies. As you can see here, Scholastic is expecting higher earnings per share over the next 3 years, but they are slowly declining, whereas New Oriental's earnings are slightly growing year over year. New Oriental's dividends per share remain constant over the next 3 years, whereas Scholastic's is slowly declining. Let's move on to the final part of our education category and review my recommendation. Today we looked at financial ratios, analyst recommendations, and stock performance for New Oriental Education and Technology Group, Chegg, Houghton Mifflin Harcourt Company, Pearson plc, and Scholastic. Based on what we have reviewed, my recommendation is to go with New Oriental. A few things you should know about New Oriental before we wrap up with our education companies. New Oriental is a private education company based in China that trades on the New York Stock Exchange. They focus their capital structure solely on equity and try to reduce their debt. As you can see here, Their weighted average cost of capital, or what it costs the company for every dollar that is raised, is at 8.3%. They add an economic value of about $32.6 million, gaining a 10% return on their invested capital. Lastly, as you can see by the chart to the left of me, their long-term debt is at zero. Their net income is slowly increasing. Their equity and revenue have been increasing steadily over the last 5 years, ending 2016 at almost $1.5 billion. And their assets have been growing steadily too, ending with assets of $2.3 billion. This is New Oriental Education and Technology Group Incorporated, and it's my recommendation out of the 5 education companies I've analyzed. Now, let's take a look at 5 utility companies, all in the energy business. Moving again from left to right, you can see at the top of the screen the companies we will be reviewing today are Exelon Corporation, Dominion Energy, Entergy Corporation, First Energy, and Sempra Energy. Let's dive right into the ratios. The first 3 categories of ratios I will be covering are profitability, as well as an ROE decomposition, leverage, and liquidity. Let's take a look at 3 of the profitability ratios. Starting again with the return on equity, a ratio that tells us the amount of net income returned as a percentage of shareholders' equity, we see that Entergy and First Energy have been declining in the last couple of years. Dominion, Exelon, and Sempra have remained relatively constant. Moving over to the return on assets, a ratio that tells us asset efficiency, we see that again, Entergy and First Energy have not been utilizing their assets greatly. The other 3 companies have remained relatively constant. Lastly, as for profit margin, we see our top 2 performers were Dominion and Sempra, while our bottom 2 performers are, you guessed it, Entergy and First Energy. At this point, it is safe to say we can eliminate First Energy from our potential investments. Let's move forward to our ROE decomposition. Starting with the tax burden, we see that Entergy is paying the least in taxes, while Sempra is paying the most. When reviewing the financials, Entergy actually received a tax credit the last 2 years. Dominion, Exelon, and Sempra remain above 50. Moving on to the interest burden, we see that Entergy had a significant spike in interest obligations to their creditors. The other 3 companies remained relatively constant over this period of time. On the bottom left, we see the EBIT margin, representing profitability from the company. Entergy has the lowest EBIT margin, while Dominion and Sempra have come out on top. Lastly, when we look at the asset turnover, we see that all of the companies have a great asset turnover, or average for their industry. Let's move on to leverage ratios. Starting with the equity multiplier, you will see that this industry holds relatively high equity multipliers. Just as easily as the equity multiplier magnifies gains, it can also magnify losses. Entergy and Dominion have been taking on the most risk in this equation, compared to Sempra and Exelon, coming out on the bottom, but still having an equity multiplier greater than 3.5. Let's move on to the right, where we can see the long-term debt that each company has been taking. Dominion has a long-term debt ratio of 42 as of the end of 2016. Meanwhile, Exelon has the lowest, coming in 14 points lower the same year. Lastly, the times interest earned ratio, showing how many times a company can pay off its interest obligations, Dominion and Exelon come out on top, while Entergy is performing in the negatives. Moving on to the final ratio category, let's take a look at the liquidity ratios of our final 3 companies, Dominion, Exelon, and Sempra. Beginning with the current ratio, we can see that Exelon has the greatest chance of paying its debt obligations utilizing its assets, barely breaking even, while Dominion and Sempra are appearing to be able to only pay off half of its debts using its assets. Refining the formula, removing inventory, we see that Exelon is clocking in with the highest quick ratio amongst the 3 companies, yet has been declining over the last year. Lastly, all 3 companies are about even with their cash ratios, again a ratio used on a worst-case scenario basis. Now let's go back to the energy page and take a look at the recommendations from analysts. Here we will review analyst recommendations on our 3 remaining energy companies, starting with Dominion, represented here by its ticker D, based on 24 analyst recommendations with a 3.73 out of 5 consensus rating. Only 36.4 are recommending buying, while 63.6% recommend holding the stock. None of the analysts recommend selling. Moving on to Exelon, represented by its ticker EXC, based on 25 analysts with a consensus rating of 4.22 out of 5, 6.9% are recommending buying, and 39.1% recommend holding the stock. Lastly, Sempra Energy, represented by its ticker SRE, has 18 sources with a consensus rating of 4.06 and a 53% buy rating. At this point, I would say that it is safe to eliminate Dominion from our potential investments based on the lower consensus and buy recommendations. From here, prior to making my recommendation, we are going to take a look at the stock performance from our final two energy companies, Exelon and Sempra. As of today, July 14, 2017, Exelon is trading at $36.06 per share. The calculated value of the company's stock, factoring in potential dividends and stock value with a growth of 6.5% year over year, we see the stock is valued at $47.69. Exelon is an undervalued stock. On the other hand, Sempra is currently trading at $112.15 with a calculated value of $164.69. Sempra is also undervalued. Lastly, let's take a look at expected earnings and dividends per share for both companies. As you can see here, Sempra is expecting higher earnings per share over the next 3 years, and Exelon's appears to be slowly declining. Exelon's dividends per share remain almost constant over the next 3 years, as does Sempra's. Let's move on to the final part of our energy category and review my recommendation. Today we looked at financial ratios, analyst recommendations, and stock performance for Exelon Corporation, Dominion Energy, Entergy Corporation, First Energy, and Sempra Energy. Based on what we have reviewed, my recommendation is to invest in Exelon. A few things you should know about Exelon before we wrap up with our energy companies. Exelon does take on a significant amount of debt, as do all the utility companies. As you can see here, their weighted average cost of capital, or what it costs the company for every dollar that is raised, is at 4.2%. They add an economic value of about $4.2 billion, gaining a 10% return on their invested capital. Lastly, as you can see by their chart to the left of me, their long-term debt is over $25 billion. Their net income appears flat. Their equity and revenue have been increasing steadily over the last 5 years, ending 2016 at just over $31 billion. And their assets have been valued at $114 billion. This is Exelon Corporation, and it is my recommendation out of the energy companies I've analyzed. Now let us move forward by discussing the top education company and the top energy company on our top 2 comparison page. For Exelon, I would recommend buying or holding the stock due to its potential. I believe this investment is for long-term investing. Exelon would be best suited for older individuals or for those seeking more stability in their investments, as well as having lesser risk, also resulting in a lower return. For New Oriental, I would recommend buying or holding the stock. This investment is for short-term investing. New Oriental would be best suited for younger investors seeking a better financial gain, those seeking higher dividend potential, as well as those seeking greater stock performance with greater returns. However, that does come with greater risk. Finally, let's check out our shopping bag to show you the earning potential between the final 2 companies, where you can make a decision as to which company you feel is best suited for your needs. These are the stock expectations for the next 3 years. Starting with Exelon Corporation, is currently selling at $36.06 per share. Say you were to make an investment of $1,000 today. That would give you the purchasing power to buy approximately 28 shares. 1 year from now, those shares have been calculated to be valued at $39.65, including dividend payment, or $1,099.37 altogether. In 2 years, the overall value is estimated to be $1,167.97, and in 3 years, the value is estimated to be $1,241. Moving on to New Oriental Education, it's currently selling at $79.78 per share. Say you were to make an investment of $1,000 today, that would give you the purchasing power to buy approximately 13 shares. 1 year from now, those shares have been calculated to be valued at $96.17, including dividend payment, or $1,205 altogether. In 2 years, the overall value is estimated to be $1,445, and in 3 years, it is estimated at just over $1,700. Following the basic principle in finance of the greater the risk, the greater the return, we can inverse that statement and apply it here. The greater the return, the greater the risk. When considering these options for long-term investments, I would strongly recommend investing in Exelon Corporation over New Oriental Education. While New Oriental may be increasing in value at its current moment, I wouldn't see the reward of taking on that level of risk lasting for a longer period of time than an energy company that is backed by many government contracts. So, my final recommendation to you is to purchase shares in Exelon Corporation today. This concludes my Bloomberg presentation, a project for investment analysis at Southeastern Louisiana University. All data and information was taken from Bloomberg Terminal. These views and opinions from this video are my own and do not reflect on Southeastern Louisiana University. Again, my name is Robert Maddox. Thank you for watching.